Hello everyone, and welcome to an On-Chain 101 where we are going to be zooming in on the long to short-term holder cohort. Now, this particular heuristic is something that Glassnode developed back in 2020, and it's really one of these heuristics that helps us break up the supply to track the fast versus the smart money. We're looking at the supply and breaking it down based on how long different investors have actually held onto their coins. Now, on-chain analysis really does have this benefit of being able to cohort out different portions of the supply. We can look at both the supply held, but also the coins that are spent. We can look at the profit that's held and the profit that's locked in. And when we break up the supply by what we call these cohorts, these different groupings, we can do it via wallet sizes, whales versus shrimp, or in this particular case, we're doing it on how long the investor has held their coins, the long and the short-term holders. And the reason why we do this is that the longer that you've held your coins in the Bitcoin economy, both from a psychological standpoint, but also statistically speaking, the longer that you've held your coins, the less likely you are to spend them. You experience the volatility, your cost basis moves more and more into the rear view mirror. Price generally deviates both to the upside and the downside away from that cost basis over a 5-month period. So generally speaking, those who cross this 155-day threshold that we determine for long-term holders, that is essentially those that are more experienced with the volatility of the market. On the other hand, those that are younger than 5 months from a statistical standpoint are much more likely to be spent. And they're kind of like the hot ball of money that follows price around. They're far more volatile. They're more likely to react to both price rallies and price sell-offs. And much of the price action and price discovery day to day is driven by that shorter term holder cohort. So what we're going to look at today is a dashboard that we've recently rolled out that really explores this concept across many levels. This is actually full of a whole series of metrics that are now available to our advanced members. So this is part of our repackaging. We've brought a series of crowd favorite metrics, including long-term holder supply and a whole bunch of MVRV metrics. So all of the tools that you'll see today are available for our advanced members. But we are going to be exploring this from a whole suite of angles and how we can use the long and the short-term holder cohort and all of the tools that come alongside it to really assess what is going on during the cycles, look for cycle extremes, and really it's all about spotting behavioral shifts and behavior patterns. Let's get stuck into it. Okay, so here we are in the long and short-term holder essentials. And this is really a toolbox that really captures most of the behaviors that we see coming from the supply domain and also the unrealized profit and loss domain for these groups. So the first thing to note here is we have the long short-term holder supply in a stacked format. And it really gives us a bit of a view on the sense of scale. You can see that long-term holders hold the vast majority of the supply, so over 14.4 million at the time of recording. Short-term holders are significantly smaller, but on a similar scale to the exchange balances. So that's the first important takeaway, is that exchange balances plus short-term plus long-term equals circulating. So when we're looking at long and short-term holder behavior, we do actually exclude all exchange activity. So that's going to make up that kind of third component. The other thing you'll note is that long-term holder supply is quite cyclical. It has this quite wavy format, and it's generally filled in by the short-term holders. So you can see the short-term holders, when long-term declines, short-term typically increases and grows in overall size. And you can also see that this typically happens around bull market peaks. This is the long-term holders, of those who've acquired their coins at cheaper prices, taking profits all the way through the bull market, leading to an increase in the supply held by newer, less experienced investors who've essentially come in because the news cycle and all of the hype and all the excitement of a bull market, the smart money starts to exit their position at the same time as those speculators come in and take those coins off their hands. Naturally, the inverse is true. During those depressed periods, during bear markets, only those with the strongest conviction and the longest term time horizon step in, start accumulating, and hold on to that supply from that point on. And in many ways, what we're looking at here is one of those old market anecdotes, where during bear markets, stocks return to their rightful owners. That's essentially what we're seeing playing out here, where the long-term holder supply increases during bear markets, speculators are flushed from the market, and you essentially get this resetting of the cost basis. Now, you can see here we've got our long and our short-term holder supply. So these are the two input metrics to build that chart above.